Somewhere in the portfolio you're about to build. One investment will return more money than every other investment combined. Not most of the money. More than all of it. Added together. The other 999 will lose money. Break even. Or quietly disappear. And for a long time. Nobody will be able to tell the winner from the losers. Not the partners in the room. Not you. You'll spend the next 47 years finding out which one it was. And by the time you know for certain, most of the people who could have warned you will already be retired. Or dead. Or both. Level 1. The Scout. You're 23 years old. Sitting in a coffee shop that isn't yours. Waiting for a founder who's already 15 minutes late. The title on your badge says Associate. The actual job is finding 22-year-olds building things nobody's heard of yet. Before anyone else finds them. 6 hours a day on Twitter. On GitHub. On Discord servers for hackathons you never attended and never will. You cold message 40 founders a week. Most don't answer. The ones who do rarely turn into a real meeting, under 10%. Most months. And that number doesn't move no matter how good your message gets. Nobody warns you at orientation that the most important skill in venture capital isn't spotting talent. It's being ignored professionally, over and over, and staying polite about it every single time. This month, one message finally lands. A 19-year-old dropout building something in health data. Coding out of a dorm room he's technically not supposed to live in past finals week. You forward it up the chain. Nobody above you notices. Not yet. You won't remember his name in 5 years. You'll remember exactly where you were standing when someone finally says it back to you. Remember that name. That's level 1. By 25, you've earned a seat at the Monday meeting. The one where 500 pitch decks get reduced to 12 names by lunch. 500 land in the shared inbox every month. You personally read 300 of them. 14 slides each. On average, that's over 4,000 slides a month. Most of them variations on the same 6 promises. Pattern matching is the real job description. Even though it never makes the recruiting website. You're trained to spot the one shape that looks like something that worked before. Buried in a pile of shapes that don't, and most weeks. You're wrong about which shape that is. The partners call this thesis-driven investing. What it actually means is you write the word no. In writing. 97 times this month. In a kind, founder-friendly font that took a training video to learn. One of the decks you forward this week has a familiar name on it. The dorm room founder from level 1. Someone above you finally opens the file, reads 11 of the 14 slides, closes it, and says, maybe next round, without looking up. Next round is 18 months away. You don't know yet whether that round will exist. That's the associate life. 2 years in, they hand you something you didn't expect this early. Authority to write a small check without asking permission first. $50,000, your first solo decision, and your name attached to it in the deal memo. 4 sleepless nights before you send the wire. Market size, churn rate, the way the founder's eyes moved when he mentioned, almost casually, that his co-founder walked out 3 weeks earlier over equity. You send it anyway. 6 months later, the company pivots twice. Burns through the check faster than any model on your laptop predicted. And misses payroll once before catching up. Nobody tells you this in orientation. Your first deal is statistically more likely to die than survive. And you will remember the ones that die a lot longer than the ones that don't. You'll still be thinking about this one at level 9. On a night you can't yet imagine. For now, the check clears. The company survives. Barely. On fumes and a bridge loan from a relative nobody at the firm knows about. Level 3. Welcome to conviction. At 30, you get a board observer seat. A chair at the table. No vote. Full view of everything that happens in the room. You watch a 31-year-old CEO explain why the burn rate tripled and revenue didn't. His hands don't move, his voice doesn't shake, only his eyes drift to the door. Twice. During a 9-minute explanation that never uses the word problem. Nobody in the room says the word failing. Everyone in the room is thinking it. You can feel 8 people doing the same math in their heads, arriving at the same number, and saying nothing. There's a specific silence board meetings have. The kind that lands right after someone asks a question nobody wants to answer honestly. You'll hear that same silence 11 more times over the next decade. And you'll learn to read what happens in the 90 seconds after it. This company won't make it past level 6. Most of the ones in this room won't. That's not the part anyone puts in the annual letter to investors. That's level 4. By 35, you get the vote, a full board seat, a fund's money attached to your name specifically, and a text at 11:52 p.m. from a founder who just watched her CTO walk out the door for a competitor. You call her back at midnight. 90 minutes on hiring, on equity, on whether the whole thing is even worth continuing. She doesn't shut it down. 14 months later, that same company signs its first enterprise contract. $2 million. On a deal you talked her through at 1 a.m. while her co-founder cried in the next room. This is the part nobody puts in the recruiting deck. Half the value you add in this job happens off the clock. At midnight, for free, and never shows up in any spreadsheet, any annual report, any pitch to a future limited partner. Nobody will ever thank you for the 90 minutes. That's not why you answer the phone. Level 5, that's partner. At 40, the fund economics finally make sense, because now you're the one explaining them to someone else. 2% management fee, every year, regardless of performance, 20% of the profits. Called carry, split among the partners, but only the profits. And only if there are any. A $200 million fund. $4 million a year just to keep the lights on. Whether a single investment ever pays off or not. The number that actually matters is the 20%. It only pays out if the fund returns more than the limited partners put in. And that number isn't knowable for 7 to 10 years. Not an estimate, not knowable. 17 years into this career, and you still can't say, with total certainty, whether your own fund makes money. Neither can the partner sitting next to you. And neither of you says that part out loud in front of the limited partners on the call. You've stopped checking the portfolio spreadsheet every morning. It tells you almost nothing you didn't already know, and almost nothing about the one line that will eventually matter most. That's the job. That's level 6. Then it happens. The thing the whole model was built for. The thing every rejected deck and every midnight phone call was quietly betting on without anyone saying it out loud. One company from 6 years back. A seed check for $200,000. Written when the founder was 24 and sleeping on a friend's couch. The same founder you almost passed on because the deck had a typo on slide 4. Gets acquired for $11 billion. The fund owned 4%. Do the math out loud. Once. Because it's worth hearing. 4% of $11 billion is larger than every other investment in the portfolio combined. Larger than the fund itself. Larger than 14 years of rejected decks and board silences and wired checks that never came back. Added together. Here's what nobody explains at the start. Venture capital doesn't reward being right most of the time. It rewards being right exactly once. At the right size. And being wrong everywhere else without any of it mattering at all. That's the whole business. Hiding inside one phone notification you almost didn't open because you thought it was another investor update. Somewhere in the building, someone opens a bottle of champagne nobody budgeted for. You don't drink any of it. You're already thinking about level 8. How a number this big changes what happens next. That's level 7. At 50, the job flips completely. You stop asking founders for equity and start asking pension funds and university endowments for $100 million, sometimes 200. sometimes 500. Based on a track record that boils down to one great outcome and a lot of educated guessing dressed up as strategy. You fly to Connecticut. You fly to Abu Dhabi. You give the same 14 slide deck 60 times in 4 months. And slide 9 is always the $11 billion company from level 7. Because that's the only slide anyone remembers afterward. Somewhere around flight number 30, it lands on you. You now spend more hours pitching investors than investors ever spent pitching you. Back when you were the 23-year-old at level 1. One number decides most of these meetings before you've finished talking. Nobody asks about the 97 decks you rejected, only the one you didn't. Level 8. The fundraisers climb. By your late 50s, your name alone gets a founder a meeting before they've written a single slide. 23 years, 4 funds, 1 outcome that changed everything. 100 quiet failures nobody remembers. Because failure in this business is silent, the updates just stop arriving. 1 email at a time. Until eventually so does the company. A 26-year-old founder sits across from you now, and something about him is uncomfortably familiar. The exact posture of the version of you that used to cold message strangers on Twitter and get ignored 90% of the time. You still say no, most of the time, 97 times out of 100. Same number as level 2. Except now the room goes quieter when you say it. And nobody asks you to explain why. You almost said no to this one too. On instinct. Before catching yourself. And wondering. For exactly a second. If that instinct is wisdom or just fear wearing a nicer suit. That's level 9. At 70, you don't run the fund day to day anymore. You sit on an advisory board. And once a year, a journalist calls asking about the deal. The one that returned the whole fund. Back at level 7, the one everyone still asks about. 40 years later, before they ask anything else. 40 years in this business. And 1 decision, made in 9 minutes. Over coffee, with a tired 24-year-old who had a typo on slide 4. Outweighs every other decision you ever made. Combined. The watch on your wrist reads the same kind of time it read the day you wrote that first $50,000 check. It doesn't know what the fund returned. It never did. It just keeps ticking. The journalist always asks the same last question. Would you do it again? Knowing the odds, you always give the same answer. You never mean it the same way twice. That's level 10. That's the whole climb. Somewhere right now, on a college kid's wrist, an old Casio is ticking. He's reading a pitch deck he doesn't understand yet. In a coffee shop that isn't his. Waiting for a founder who's already 15 minutes late. He doesn't know which deal, out of the 1,000 he'll pass on, is the one that matters. Neither does anyone who's done this longer than him. Not the partners. Not the legends. Not the ones with buildings named after them on Sand Hill Road. This is the climb. 99 times wrong. And once. Exactly once. Impossibly right. The math only ever works if you're still in the room when it does. 1 level at a time.